Hi, everybody. Today we'll be talking about the Mirae Asset Seng Tech ETF FOF. Now, to take this ahead with us, we have Mr. Siddharth Srivastav, who has been associated with the Mirae Asset Mutual Fund since October 2018 as head ETF Products. He looks after the passive investment products at Mirae Asset India. Welcome to the show.
Thank you so much, Asta, for having me here.
Thank you. It's such a pleasure to have you with us here. Now, Siddharth, could you tell us more details about this fund, for example, the NFO period, and what is the investment scope of this fund, and how is the whole portfolio curated?
Okay, so this scheme is going to track the Hang Seng Tech Index. So we are coming out with both ETF as well as the fund of fund, and the underlying index is going to be the Hang Seng Tech Index. Now, it's very similar to how a lot of other tech-centric products are globally, especially in US market. This particular index tracks the 30 largest companies which are listed on Hong Kong Stock Exchange, and which are basically catering to several tech themes like internet, mobile, digital, autonomous, cloud, etc. So if you look at the portfolio, you'll typically have exposure to companies which are involved in social media, on online ordering, e-commerce, semiconductors, EVs, etc. So you'll have a very broad exposure to a lot of companies which are into multiple emerging or disruptive technologies. And a lot of these companies have already grown significantly, and some of them have very good potential to grow in future. So someone who is looking to basically take exposure in markets outside India, let's say already has exposure to US and probably is looking forward to taking exposure in Hong Kong listed companies or Greater China companies, can probably look towards having exposure in this particular fund. But having said that, we all know, and probably I'm assuming that that is going to be one of your question, is that historically Chinese markets have been more volatile. So it is typically more suited for investor who has higher risk appetite.
Got it. Understood. Okay. Now, moving ahead, at this juncture of the market cycle, what would you suggest to the investors to pick, a lump sum or an SIP investment?
So that's a very interesting question. I'm like, if you look at Indian markets right now, US markets right now, probably if you are going to invest, probably SIP investment will be a preferred mode of investment because of the valuations we are looking at, right? But in the Hang Seng Tech Index, which the product which we are coming out with, basically has corrected almost 40% from its high. And that is because of the recent regulatory headwinds which a lot of the internet companies faced from the Chinese government and Chinese regulator. So here the approach can be different. So approach can be two ways. First of all, these companies are in a way tech giants of East, tech giants of China, right? And so you can very well take exposure in these companies from a long-term point of view also. So for example, if you look at pre-regulatory issues, these companies in fact outperformed Indian markets by double-digit percentage on a CAGR basis in last 5 years, 3 years respectively. So they have had a very good wealth creation journey also. But obviously, as I mentioned earlier, the segment is volatile, right? It's more suited for people who have higher risk appetite. So you can do a strategic investment from a long-term point of view, but I think a lot of people will be interested in this product, considering that the index has corrected by almost 40%.
Yeah.
Most of the action has already taken place when it comes to regulatory actions against the tech companies. So I think a lot of people will typically find appeal to invest in this product from a valuation point of view. And again, I think that is something which people can play for 6 months or a year or two. But again, one needs to be cautious about the volatility as well as the risk, because while we believe that we have seen a lot of headwinds already, but in coming quarters you may see some headwinds again.
Got it. All right. So could you help us understand the taxation on this fund?
Yeah, so any scheme which is taking predominant exposure in global markets, the taxation is basically like the debt-oriented scheme, even if it's an equity fund. So any equity fund which invests predominantly in global markets like Hong Kong, like US, gets classified as a debt-oriented scheme from a taxation point of view. So if you're looking at tax, basically it is, if the investment is less than 3 years, it is basically a personal tax slab. If it is more than 3 years, and the tax is 20% with the benefit of indexation. And indexation at times reduces your tax liability significantly. So typically people, when you're talking about US market, especially typically people invest from a long-term point of view, also for more than 3 years in international funds to get that benefit of indexation.
Got it. Okay. And from an investor perspective, how is this fund different from the available offerings in the same space?
So typically when Indian investors look to invest in any mutual fund, first of all we see home bias, right? I think that is true for any investor, be Indian or outside India, right? We typically look at opportunities in Indian market also, and that is how we start the journey, and then we look toward outwards. Let's say the first intent is probably to invest in US market because you find it more relatable, or you are more aware about that market. You find the companies more relatable. Now that is typically people look towards first, and then people obviously start looking towards the other opportunities which are there in the global markets, including, let's say, China, which is the second largest economy globally at $14.7 trillion. It is multifolds larger than India. The digital and tech segment itself contributes around $5.7 trillion in Chinese GDP. This has grown from 14% contribution the GDP to around 35% right now, and GDP itself has grown by an average of almost 9% in the last 30 years. So someone who basically wants to take exposure in in uh, in these tech giants, right, of Chinese economy, probably they will find this product more suitable from investment point of view. And also, as we said, that the correlation also helps in a way, because that will eventually lower the risk of your overall portfolio if you're investing in a product which is less correlated with your other major portion, which typically for Indian investors are Indian mutual funds.
Got it. Okay. And could you help us understand the importance of passive exposure and what are the cost benefits attached to it?
Yeah, so I think there has been a lot of conversation which is going on regarding active versus passive, especially in Indian markets. But I think passive is especially very strong way to take exposure in global markets, because it does multiple things. First of all, when you're investing in foreign markets, uh, the the passive fund which tracks an underlying index just provides you a transparency, first of all, in terms of methodology, right? You're always aware what sort of
Yeah.
method driven approach the fund has. You're also aware about the portfolio on the underlying stocks at all time, and it just helps you in taking the judgment whether I should invest in that fund or not, and gives you comfort. For example, a Nasdaq 100, you always know that it will track non BFSI companies which are listed on Nasdaq 100. A FANG Plus will typically invest in 10 uh, tech giants in an equal weighted manner. So that sort of transparency, especially in the global markets, is something which is appreciated by the clients. Secondly, if you look globally, I think this has been talked in much detail already. If you look globally, the active schemes are struggling to outperform the benchmark on a consistent basis. We are seeing that happening in India, but this is happening in global markets since a very long time. So again, the conversation tilts towards the passive. And lastly, if you consider the cost, we are talking about the ETF around 45 basis point, the direct plan of fund of fund around 65 basis point, including the cost of underlying scheme, which means that the product is at a very low cost. I'm like 0.45% TER for an international fund like Hang Seng Tech is very appealing, because if you compare it with the active plans, which are typically around 2%, you are saving 1.5% TER directly.
Yeah. Got it. Now, initially, since you mentioned the term risk, so what are the kind of risks involved in this fund? Could you help us understand that?
Yeah, so I think first of all, whenever you are investing in any global fund or any international market, uh, the risk increases, right? If you are looking at it in a silo,
Yeah.
because you are getting exposed typically to regulatory issues towards with the political issues, with the economy, and the market, etc., of that particular country.
Mm.
So, for example, had you invested in Hong Kong, China, or US, all these new risks come into picture. Even currency risk also, right? When you're investing in foreign markets, you're investing in a different currency. So all those risks are something which affects your portfolio. But
Mm.
in China, also, what is one thing which investors should realize before investing is that country typically is has seen more strong-handed approach from the government as well as regulator in recent month, and typically that just increases the risk for this fund also. So while we have seen a good wealth creation journey,
Yeah.
and now we are seeing very attractive valuations, right? But it is again, as I'm repeating multiple times, that investors should also understand the risk before investing, because ultimately you should only invest in the product if it aligns with your risk profile. So in case of China, typically your risk is typically amplified because there is some sort of opaqueness regarding the regulatory action, regarding the government action in this space, while we see most of it has already happened in terms of uh, 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 penalties being imposed, new regulations being brought out to govern the space. But we may see some more action in near future, and ultimately years down the line we may see other things also, which is very particular to Chinese economy.
Got it. Okay. And what should be an ideal investment time horizon that an investor should consider before investing in this fund?
So this fund, as I mentioned earlier, is a bit different, right? Typically, whenever we talk about investing in foreign markets, we talk about long-term allocation, and that is true for this product also. That ultimately, even more so than India, if we are investing in foreign market, and if you want to basically see the entire wealth creation journey, you should stay invested for 3, 5, 7 years at least, and then see it happening. And if you look at the Hang Seng Tech performance before the regulatory crackdown, then you will find that this index has generated significant wealth, right? As I mentioned, that it has outperformed Nifty 50 by lower double-digit margin on a CAGR basis, and since inception in 5 years and 3 years, respectively. In fact, uh, Feb ending, if you look return performance, that is before regulatory issues, on a 2-year basis, it outperformed Nifty 50 by almost 33%. 1 year around more than 50% plus. So there has been significant wealth creation which this index did before this regulatory issues. So people can invest in this fund from a long-term point of view also. And as I mentioned earlier, that you also get the tax benefit, right? You get the
Yeah.
benefit of indexation if you have invested for more than 3 years. But having said that, I think a lot of people will also look at this product from a value play point of view, that they invest tactically for some time, right? As I mentioned, that index right now is down almost 40% from its all-time high. If you look at trailing PE, that is also, if you compare it with average, it's down by almost 38%. So from a tactical point of view also, I think some people will find it attractive to probably invest for some time, and as and when um, things become clear
Yeah.
from the regulation point of view, and if we see some upswing in the performance of these tech stocks who have
Yeah.
corrected heavily, then that might benefit the people who are doing tactical allocations.
Right. Got it. Okay. One final question before we close. What is the total AUM that you're looking at for this fund?
It's pretty hard to say, and I won't I won't guess that,
Okay.
but we are launching this product from a long term point of view, because what we I like to say is that had this correction not taken place, then still we would have gone ahead with this particular product, because we believe that portfolio is very appealing in terms of kind of companies it is capturing across the tech domain, starting from e-commerce to social media to healthcare IT to electric vehicles to autonomous vehicle to cloud to semiconductors. We are getting basically portfolio of companies across emerging and disruptive tech. So I think we are happy to collect whatever we collect in the NFO, and then we
Right.
hope that this product grows over a period of time into a big scheme.
Absolutely. We hope the same. And thank you so much, Siddharth, for coming on. It was such a pleasure to have you here. We do wish you all the very best. Thanks a lot.
Thank you so much, Asta.
Thanks.
Brokerage shall not exceed SEBI specified limit. Investment in securities market are subject to market risk. Read all the related documents carefully before investing.